Puerto Rico's plight affects most people with a mutual fund invested in the municipal bond market. The region has taken on ballooning debt and tumbled over a fiscal cliff, but the solutions are not cut and dry. Here's the situation. Puerto Rico has giant debt troubles totaling $70 billion, and it'll default on its most recent $422 million bond payment. Next up is a $2 billion bill for principal and interest payments due on July the 1st. The debate is brewing in Washington over how exactly to move forward, since Puerto Rico and its agencies are not allowed to use bankruptcy to restructure debts. The U.S. Congress is struggling with a bill that could allow the region to restructure its debt and implement a federal oversight board that would weigh in on the Commonwealth's budgets. And in March, the U.S. Supreme Court heard arguments on whether Puerto Rico can reinstate a local law that would give its utilities additional leverage in talks with lenders. Here's the background. In the mid-2000s, big banks flocked to the island, creating new bonds after the territory adopted a sales tax. Banks raked in nearly $1 billion in fees, while Puerto Rico took in more than $126 billion. But the economic conditions changed when the U.S. phased out special tax breaks for the island. Since 2006, the island's economy has contracted every year except for one. Unemployment is rising and the population is dwindling. It's now about 3.5 million, and it's on track to hit a 100-year low by 2050. Here's the argument. Republican lawmakers say a control board could make the politically unpalatable decisions Puerto Rico needs to repair its public finances, while the government has closed scores of schools and proposed tightening an inefficient tax collection system. Critics say it hasn't done enough. The Obama administration and Puerto Rico's governor, Alejandro Garcia Padilla, say federal oversight must be paired with a plan to give the island access to an orderly bankruptcy process that would help cut its liabilities and avoid protracted litigation. Meanwhile, bond investors and insurers oppose the move because it could force them to take losses. The Conservative Heritage Foundation characterizes it as a bailout.